which retirement account actually grows your money faster, a Roth IRA or a 401k? By the end of this video, you'll clearly understand how both work, their pros and cons, and how they affect your money over time. A quick note, this video is for educational purposes only. I'm not a financial advisor, and this is not personal investment advice. Let's begin with the 401k. It is a retirement account you can get through your employer. When you sign up, a part of your paycheck is automatically placed into this account. This makes saving really simple because it happens before you even see the money in your bank account. One of the best features of the 401k is the employer match. Many companies will add extra money to your account when you contribute. For example, if you put in 3% of your paycheck, your employer might also put in 3%. That's free money, and it's one of the fastest ways to grow your savings. Another big advantage is the high contribution limit. In 2025, you can contribute over $23,000 per year if you're under 50. If you're 50 or older, you can add even more as a catch-up contribution. This makes the 401k one of the most powerful ways to save a large amount of money for retirement. There are two main types of 401ks, traditional and Roth. With the traditional 401k, you put in pre-tax dollars. That means you don't pay taxes now, but you will pay taxes later when you withdraw the money in retirement. With the Roth 401k, you put in after-tax dollars. That means you pay taxes now, but when you retire, your withdrawals are tax-free. Many employers today give you the option to choose between the two. Now, let's look at the Roth IRA. IRA stands for Individual Retirement Account. Unlike the 401k, this account isn't connected to your employer. You can open one on your own through a brokerage, bank, or online investment company. With the Roth IRA, you also put in after-tax money. That means you've already paid taxes on it. The benefit is that your investments grow tax-free, and when you retire, you can withdraw your money without owing any taxes. This is one of the biggest reasons people love Roth IRAs. The contribution limits are lower though. In 2025, you can put in $7,000 a year if you're under 50 and $8,000 if you're 50 or older. That's a lot less than a 401k. Another limitation is income. If you earn too much money, you might not be able to contribute directly to a Roth IRA. But for many people, it's still a great option. One more advantage is flexibility. Roth IRAs often give you more choices of what to invest in: stocks, index funds, ETFs, bonds, and more. With a 401k, your employer usually chooses a list of funds for you, which can sometimes be limited. Now comes the big question: which account actually grows your money faster? Let's look at an example. Imagine you invest $500 a month for 30 years. We'll assume an average annual return of 7%, which is close to the long-term historical average for the stock market. In a 401k, if your employer gives you a 3% match, that's like adding about $180 extra each month. Over 30 years, your account could grow to more than $750,000 before taxes. Remember, with a traditional 401k, you will owe taxes when you withdraw the money. If your retirement tax rate is, let's say, 20%, your spendable amount might look closer to $600,000. Now, what about the Roth IRA? If you invest $500 a month into a Roth IRA at the same 7% return, you'd end up with about $610,000. That's a bit less than the 401k with a match, but here's the key difference. In the Roth IRA, all of that money is yours to keep, tax-free. No taxes on withdrawals. So in terms of pure balance, a 401k with a strong employer match usually grows faster. But in terms of after-tax value, the Roth IRA can be just as powerful, sometimes even more, depending on your tax situation in retirement. Taxes are a huge part of this comparison. With a traditional 401k, you save money on taxes now, but you'll have to pay them later. With a Roth IRA, you pay taxes now, but you get tax-free money later. Which is better? That depends on your future tax bracket. If you think you'll be in a higher tax bracket in retirement, a Roth IRA may be the better choice. If you think you'll be in a lower tax bracket, a traditional 401k could save you more money. Nobody can predict future tax rates with certainty, which is why many people use a combination of both accounts to spread out the risk. Let's quickly review the pros and cons. 401k pros: higher contribution limits, employer match, and upfront tax benefits with the traditional version. 401k cons: limited investment options, required minimum distributions in retirement, and taxes owed on withdrawals unless you use the Roth version. Roth IRA pros: tax-free growth, more flexibility in investment choices, and no required minimum distributions during your lifetime. Roth IRA cons: lower contribution limits, no employer match, and income restrictions. Many people start by contributing enough to their 401k to receive the full employer match because it effectively adds extra money to their account. After that, some choose to put additional savings into a Roth IRA to take advantage of tax-free growth. Using both accounts can offer flexibility in retirement, as some money may be taxable and some tax-free. The right approach depends on individual circumstances, so it's important to consider your own goals. It's also important to remember the power of compounding. Whether it's a Roth IRA or a 401k, the earlier you start, the more time your money has to grow. Even small amounts can turn into large sums over decades. For example, investing just $100 a month for 40 years at a 7% return could grow to nearly $240,000. If you invest $500 a month for 40 years, that's well over $1 million. The account you choose matters, but starting early matters even more. So, which grows your money faster, a Roth IRA or a 401k? With an employer match, the 401k often wins in total contributions, but with tax-free withdrawals, the Roth IRA can be just as powerful, especially if tax rates rise in the future. For many people, the smartest choice isn't one or the other, but a mix of both. The most important step is simply to get started. If you found this video helpful, be sure to like it, subscribe for more.